Hello and welcome to episode one of my illustration series where we break down life insurance and annuity illustrations. We get down to business, we look at the numbers, and we talk about these financial products and how they can benefit you and your family. When we think about life insurance, sometimes we think it's just the death benefit to leave behind to our family. As some of us know, life insurance is much more than that. And for episode one, I wanted to talk about mortgage protection, specifically permanent mortgage protection. Your typical mortgage protection life insurance plan is a 30-year term for a 30-year mortgage. But as we all know, things change, and most people actually end up refinancing their home, creating a whole nother loan with a whole nother 30 years. And so that's what I think makes a 30-year term kind of unviable. With permanent life insurance, as we know and as we can see here, you'll get cash value accumulation, which is money that you can access while you're living. And I have seen how people have term life insurance policies that expire and they're typically not excited about that fact. I think most people would rather lock in life insurance, permanent life insurance when they're young, and they'll have something that's permanent and it's going to last their entire lives, never going to expire. So for all of those reasons, that is why I am showing you my permanent mortgage protection life insurance concept. So let's get into the illustration here. As you can see, life insurance offers more than you might expect. You get a death benefit, obviously, but you also get accelerated death uh, benefits, which that means you can access your death benefit or accelerate your death benefit while you are living with a qualifying illness. And that is money that you can use to pay the mortgage. It could be used to pay medical bills. So imagine you are the breadwinner and you lose your income because you are sick. If you don't have a plan like this in place, you may lose the home because it would become unaffordable otherwise. And so that's really the power of accelerated death benefits. You also get cash value accumulation. So as you pay premiums, you're going to slowly and surely build cash value that participates in the market because this is an indexed universal life insurance contract. You get to participate in indices with zero downside risk, which over time you will see the power of uninterrupted compounding growth. So I want to show you here the living benefits page. If the doctor tells you you have a year to live, God forbid, you could access your death benefit while you're living. If you can't do two of the six daily living activities like bathing, getting dressed, feeding yourself, you could access just under $75,000 annually until your death benefit runs out. If you have a critical illness, which would be heart attack, stroke, cancer, something like that, at age 60, you could pull out $20,000, which again can be very beneficial. It can help you in a critical time of need. So the next thing that we want to look at is and it's what everyone wants to look at, is the actual illustration. How is my cash value going to grow? Am I going to have a permanent death benefit? Well, let's take a look here. Let's start at the very top. We are going to assume that I am age 40, standard rating. I am a non-smoker. We are going to assume that I want a $400,000 death benefit, maybe because I have a $400,000 mortgage balance. If I want a permanent 400,000 and I want to pay up my policy in 25 years, in other words, I want to stop making premium payments at age 65, maybe because I want to retire, that's going to cost me $370 a month, $4,444 a year. And this is a, a permanent life insurance policy. So as you can see, If you live to 120 years old, you're going to have well over $1 million. But this is also a guaranteed contract. So there's a provision in here that basically guarantees your death benefit. So it essentially becomes a whole life insurance contract. Obviously, it's not a whole life, it's a universal life, as you can see here in the top right, which just means that it's flexible. So as you can see here, um, you'll have a permanent $400,000. Let's actually talk about these columns here. You've got three columns. You got the guaranteed, you got the alternate, and you got the assumed. So guaranteed is an impossible situation. This is assuming the market doesn't do anything, and the insurance company will give you an average of 2% per year. The alternate is assuming the market just performs really terribly and just doesn't perform. This is a worst case scenario column, I would say. This far right column is the assumed column. This is based off a historical look back. And so this is the most likely scenario here. So this is really what I'm going to discuss with you today. You'll see your account value here, and you'll see your surrender value. There is a surrender period, which just means if you surrender your contract, you're not going to have access to the full amount of your cash value. There's going to be surrender charges. After the 15 years and you're 16, everything's the same. So the reason why you want to have a permanent contract with cash value is because let's say you're 65 years old, you raised kids in your home, and it's time to touch it up. It's time to remodel, it's time to make home improvements. Then you can use this cash value here to do whatever you want on the home. And so this is your dedicated mortgage plan where if God forbid something happens, you pass away, this $400,000 can be used to pay off the home. If you get sick, you can accelerate your death benefit. It can be used to make monthly mortgage payments or pay off a large portion of the principal or pay the cost of healthcare and things like that. But I hope you guys can see the power of this financial vehicle. I mean, we've got uninterrupted compounding growth here. There's zero risk. You have permanent life insurance. Let's say the market doesn't perform well. Let's look at this alternate column here. Let's say uh you put in what would it be? Oh, you put in $111,000 over the course of 25 years. Your cash value is 106,000, but you could pull out all of your money that you paid in, which would be a return of premium. You could surrender your contract, get all of your money back, which basically just means that for that 25-year period, the insurance company was on the hook for $400,000 and you got all your money back. So it's basically free insurance. And so that's really powerful if the market doesn't perform. But if the market performs, you're actually going to have more than what you put in. And so that's very powerful. If you do not surrender your contract, then, by the time you're 80 years old, you're going to have a $250,000 cash value that you have access to do whatever you want. It doesn't have to be mortgage specific, but that's the way I like to describe these plans is this is money for your house. And again, once your cash value reaches your death benefit's going to start to slowly increase. So guys, this is an amazing vehicle. And of course, you're the youngest and you're the healthiest you're ever going to be today. So now is the time to look into an indexed universal life insurance policy to accomplish specific benefits. But yes, this is episode 1, and this is my permanent mortgage protection concept. So thank you for watching. I'm looking forward to the next episode where we will discuss another concept using life insurance. Do not forget to like, do not forget to subscribe, add me on Facebook, DM me, slide in my DMs on Instagram, whatever. Again, thank you for watching, and I look forward to the next one. Thank you.